Welcome everybody. Tuesday, very volatile Tuesday, March 21st here at MarketStream.live. Welcome to Strategy Now. My name is Joseph Cusick. Securities offered by MoneyBlock. And it's pretty appropriate that I have this backdrop up because on the 16th, that was last week on Strategy Now, we talked about using VIX to hedge. Not bad. Go back to MarketStream.live. You can go to the latest videos and go to Strategy Now, and you can actually review that segment on utilizing VIX and volatility options to potentially hedge a portion of your portfolio. Take a look at that. But this morning I was talking about what's hot in the open about finance. We ended the session talking about how the XLF is pulling back with the strength in bonds, seeing those bond prices come up, that safety trade on. And this is the situation that we've been kind of looking for. Looking at markets, they've been strong. Finance, taking a look at XLF, which is the ETF that tracks the finance sector, been pretty decently strong. It's been consolidating here for the last couple of weeks. And now the last three sessions, and today, most notably, down 2.79%, blew through its 20 and its 50-day moving average. Next support is really coming in at this level where it's challenging right now at $23.60, $23.50. Then you're going to see $23, and then you got 21. That's long-term support with the 200-day moving average. So I said, well, why don't we start talking about a strategy that you could start to deploy if, in fact, the market continues to pull back and you want to get into underlying stocks, but you want to get in at lower prices. For example, in finance, getting in at that 23 to 22.5 level. As a matter of fact, if we kind of zoom out here, you can see the next support levels come in here right around that $23.90 level, $23. And then your next support level is going to come in at 22. And then after that, you really got to come down into that 19.20 level, which is that 200-day moving average. So we're really going to focus on how we can ladder some puts, and specifically short puts. And we'll start with cash-secured short puts, and then I'll show you an approach that you can utilize so that if you don't have the capital to do cash-secured, we can actually do put credit spreads, which we've talked about in the past. So taking a look at XLF, you can clearly see that it's under stress. The market in general is under stress. You got the Dow Jones down 200. First time that we've seen the market down 1%, and I can't remember how long. And you got the S&Ps down 1%. You have the NASDAQ down 1%. You have the Russell 2000 down 2%. And you have the volatility VIX up 11.5%. You have the dollar down 0.6%. And you have bonds up 0.75% on the 10-year, 1.5% on the 30-year, and you have the 2-year up just about 0.1%. The shorter end of the curve, obviously more sensitive to short-term rates and not really perceived as a safety trade as much as the 10-year and the 30-year. All right, so let's jump in and take a look at XLF. So I'm going to go to the trade platform. I got XLF lined up. You go down here, and I'm going to display the Greeks. And the put that I'm going to look to sell is going to have about 31 to 40 days left. I'm just going to look at the April monthlies. And the strike price that I'm going to look at is going to be right around the 30 delta put option to sell. And that's going to be the $23 put. Now, stock's trading at $23.63. It's trading on its lows right now, down 63 cents on the stock. So I'm looking at selling an option. I'm going to sell this option for about 25 cents. So you scroll up, you got single, I'm selling. Now, I said I was going to do this cash secured. I'm going to sell one contract because I have about 21,000 in available buying power and I have about 25,000 in the account in total. So I'm going to do one contract. I'm going to do it for a limit price of 25 cents or better. Now, I want to review this order and also explain what the risk and reward factors are here. First of all, between now and April expiration, I could potentially own stock at $23. Now, my stock price that I'm going to be assigned, because when you sell a put, you're saying you're willing to take delivery or assignment to own stock at the strike price of the put option you sold. Now, I like the price of 23. I see support there over the next 30 days potentially. But my assignment price is going to be 23 minus the premium I receive, which is a quarter or 25 cents. So my actual underlying price where I'd be getting long stock, if in fact the stock is at or right below $23 at expiration, is going to be $22.75. That's 23, the strike price, minus 25 cents. Okay, that's $22.75. That's where I'm going to own 100 shares. Now I'm going to have over $2,200 in my account in cash to buy this outright. Now some of you go, whoa, wait. I don't have $2,200, or in other words, having 10% of my account, even though I have $25,000 account, I might have the cash available. I may not want to put 10% of my account at risk in XLF. How can I mitigate some of that buying power reduction in buying the stock outright? Well, what you can do is go back to change order. And what I'm going to do is I'm actually going to set up the trade rather than as a cash secured short put. I'm going to scroll down. I'm going to display the Greeks so that we can see the deltas. And I'm going to put in more strikes. I want to scroll down to the same expiration month, April 21st. I'm going to look to sell the $23 puts. But I'm going to buy the basically an option that's the first nickel option. In this case, you could do the 20.5, or I'm actually going to do, let's do the $20, 23, yeah, we'll do the $20. I'm going to buy these $20 puts as protection. Okay, remember, that's where I saw long-term support right around that $20 level. That's going to cost me 4 cents. So the strategy that I'm deploying right now is I'm selling the 23 puts like I originally did on the cash secured side, but I'm buying some insurance. I'm buying some insurance at $20. That's the puts that I'm buying. So that's going to reduce the total amount of credit I'm going to receive from 25 cents to about 20 cents. Now, that being said, is it worth, taking that 5 cent hit on your potential credit? Sure. And here's why. The reason why is because I no longer have to have the $2,200 or $2,250. I only have to have the difference between the strike prices, which is 23 minus 20. So that's $3, or in other words, $300 per spread contract that I sell. I'm selling the 23s, I'm buying the 20s. They're expiring in April, so they have the same expiration. Now, I'm going to collect about roughly, let's say 22 cents. So my actual requirement is the $3 minus the 22. So I really only have to have $278 in my account, and that's all I'll have at risk between now and April expiration. Now there's some maintenance things that you have to think about. What happens if the stock is in between these two puts? We'll talk about that on other episodes of Strategy Now. But the point being is that now I only have to have 1/10 of the capital to be in this position. I could potentially make $20 or $22, not including commissions, to have a risk of around $270. You're looking at a rate of return of roughly on the total account about 1%. On your risk capital, in other words, the 278, you're looking at a 10% return, or right around there, 9% return. So you're seeing that you're having, you're not putting up as much risk capital. You have the potential to, and I'm actually going to put this in at let's say, I'm going to do this at 21 cents. That's the prevailing market. Let's see what I get. Review. And so bottom line is that now I'm placing this order and I'm going to do it as a spread. And the reason why is because it fit my risk tolerance, my objectives, how much risk capital I wanted to put out, and I got filled at 23 cents. Okay? So I sold to open the $23 puts. I bought some insurance and used some of my premium that I received. So I sold them for 25 cents. I paid 2 cents. So I basically took in 23-cent credit. I only have to put up $277 per spread contract. So I, as a matter of fact, could extend that, and I could have done, let's say, 5 contracts that fits within my 5% of the total account value ever at risk. And the point being is that now I'm participating in a market that has been trending down, but has overall been going to the upside. You have a market in general that's trending down. And this is where you could ladder this in. I actually could look out and I'd say, okay, I'll do 1 contract here in April. Maybe I'll do 1 contract in May and do, let's say, the $22 puts in May and buy the 19s. I could actually go out as far as June, so I could ladder these down at various months and take advantage of the excess time and potential volatility premium that's starting to build in these options as the market pulls down. But this is a way that you can start approaching adding these different market segments. For example, if you wanted to add the Dow, remember, this is that zone that I've been talking about, right? Where I wanted to potentially look at adding to or building a new Dow position. Well, this is going to be the area that I'm going to watch now. And if I see it firm up here, the bulls start to take control. I could actually start looking at maybe putting some bullish positions on in the Dow. Same thing with the S&Ps. The S&Ps are challenging this area. The NASDAQ is challenging this area. Now the Russell, this is the canary in the coal mine that I've been discussing over the last couple of weeks. Remember, this broke, now is trading on its lows. We haven't seen it challenging these levels in over a week. And now, if it gets a settlement below this level right here, this low, right, of 1553, which right now it's trading at 1552, if we start to see that challenge, now you're going to see these areas between 1340 and basically then you're looking at the next level of potential support or where there was some buying is at the 1320 level on small caps. And this is then small caps are going to be moving, especially with all of this healthcare reform that is still up in the air. They say that they're going to get it passed. They're working very hard to get it passed on the repeal and replace, but it's looking extremely volatile at best, and you're seeing the markets are reacting accordingly. All right, folks, that's it right now for Strategy Now. And as always, go back and check out our latest videos, like the Strategy Now from the 16th about how to use VIX as a hedge. All right, we will be back at 3:30 Eastern Time. I'm going to do Tech Talk, where I will be discussing some earnings and stocks that are going to be coming out and talk about their estimated moves. We'll see you then.